give you a quick overview about me, what I do, followed by my thoughts on how bankers can assist with the exit planning process. A little bit more information on commercial banking as a whole, more specifically corporate and industrial lending, and wrap up with some FAQs on the bank itself. So as a corporate banking loan officer at Cambridge Savings Bank, I primarily work with, New England-based for-profit and not-for-profit organizations who may need creative lending solutions. The loan proceeds can be used to finance working capital needs, asset purchases such as real estate or equipment, and other general business transactions. Most of my clients have revenues under $100 million and borrowing needs of $1 million or more. Of course, there's exceptions to every rule. However, I would say this describes my average client. Typically it would make sense for me to be introduced to a company when they may be growing, going through some sort of transition, such as moving from one generation to the next, acquiring a competitor or a company to help them grow, or facing headwinds such as increased competition or moving to a new territory. When done properly, exiting or selling, transitioning ownership of a business requires a lot of communication with vested parties such as family members, other owners, employees, customers, advisors like yourselves, and so on. I've learned that the most successful business owners communicate their desires and intentions to those vested parties well in advance of any changes. This approach provides people with the opportunity to voice their opinions about the decisions the founder or owner may be making, and hopefully feel that their thoughts have been heard and duly considered. As a banker, it's critical to recognize what a big deal business ownership transition is, especially to the large number of baby boomers or retirees who own businesses and will soon transition in some form or fashion. There may be more, but in my opinion, there's 5 basic options that business owners have for transitioning their business into someone else's hands. First, to sell the business to another company. A strategic acquisition can benefit businesses regardless of the owner's age. How can a banker help there? Typically, well-run bankers, we know a lot of people. We use our own network or even the bank's network to introduce the business owner to potential competitors and partners who may want to buy them. Secondly, you sell the business to an ESOP or directly to the employees. This is a very popular choice among small or family-owned businesses, and it benefits both the owner and the loyal employees. And how bankers can help there is, bankers can not only provide advice about ESOPs and make introductions to professionals, but we could also provide the initial loan an ESOP needs to get started. Thirdly, the third option would be to transition ownership to adult, children, family. This is another common and attractive solution for many small family-owned businesses. Bankers can help with that, as we can fund the upfront shares that can be repaid through dividends. We can provide term debt or real estate debt if there's real estate involved in the transaction. The fourth option would be I would say the most unfortunate option, we plan to shut down the business completely. Some owners opt to close their businesses disposing of assets. Maybe family members don't have any vested interest in the business. They don't really want to do it, or maybe their books are so bad that they can't really get anybody to really bite, even if it's not really the value they'd be looking for, but it's better than nothing. But how we can help in that situation is bankers may know of other customers who may want to buy the closing business's assets, which also helps the bank's other customers. At least the business owner is getting a little bit of money, and our customer may be getting the closing business's assets at a very discounted value, which is, I guess, good for everybody. And the last option that I've seen is, sell the business to a private equity company. Selling a large portion of ownership to an investment firm may enable a gradual transition to ownership and offer liquidity to the owner. How we can help there is, some of these deals can be partially financed through the bank's senior loans. Additionally, the bank can help calculate how much of the purchase price should be with debt versus equity, making sure that business is not overly leveraged, make sure the business can withstand any hard times with a balance sheet that's unlevered as possible. Since banks can play a key role in each of these 5 options. Bankers should be proactively asking business owners about how they plan to transition their business. It's a very delicate subject, and it's one of those conversations. At least when I'm driving, driving the calls, you're kind of thinking about how to really, approach the topic. But it's something that needs to be talked about, especially when you start getting out there with the exposures, and credit officers and board of directors are going to start asking these questions. You need to be prepared. So these are some of the recent examples where I've helped. I actually got a referral from a client of mine who is an attorney in the Greater Boston office who has a customer who happened to be this large regional HVAC company. The father was in his 60s, wants to move to Florida, and the son wants to buy his ownership interest in the operating company. The father owned 100% of the operating company and 50% of the real estate. We provided some term debt for the operating company and provided a commercial real estate mortgage to buy the remaining 50% of the ownership interest. And now son owns all the building. Dad is there as an advisor, and the business is actually doing better than ever, as the son is extremely motivated to grow the business. Another example, this is more of a private equity play, where there was an e-waste company in upstate New York. We were approached by an investor. I guess the owner wanted to retire or wanted to do something else, so we provided 8 figures of senior debt to help facilitate the buyout. It was actually a 60% equity buy-in from the private equity, so we really liked our leverage calculations there. Very similar situation here with the widget manufacturer. This is a much smaller company. This business was originally ran out of a gentleman's home garage and grew to about a $10 million business. Another situation where the owner was looking to retire, and a very small private equity firm came in to buy the business at about a 6x multiple. So the owner was able to retire comfortably, and the purchaser, their group, thought that there was plenty of dry powder to grow the business, as the current owner didn't do any advertising and they were only running about 50% capacity. So that they saw a lot of opportunity in there, and it was a great situation for everybody. And lastly, a strategic buyer for a professional service firm customer of mine. So I have a customer who does background work essentially for deals to be closed. We may write title reports, background checks, so on and so forth. So he was a customer of mine, had a line of credit with us. He got an unsolicited offer to buy the company to someone else to buy the company about an 8x multiple, and he was nice enough to give my name to the buyer, and I ended up financing the buyout of it as well. So it was a great situation there.